Hi there. So today we're just going to do a short video on depreciation. However, this is not meant to be a complete video on all kinds of depreciation. Really, this is more of a review for people who perhaps took introductory financial accounting a long time ago, and now maybe you're in intermediate and you just want to kind of get up to speed on some of the things that you have forgotten over that time period. So we're going to look at both straight line depreciation and declining balance depreciation methods with a couple of examples. And I think if you've seen this topic before, this will jog your memory quite well. So first of all, let's look at straight line. Everybody's friend. You know, everybody finds straight line pretty easy, and we all like it for that. Okay, so first of all then, let's say that we purchase equipment and we buy equipment for $140,000. I'll just fix my screen here a little bit. Okay, we buy it for $140,000 and we think at the end of its useful life, the residual value will be $20,000. Well, under the straight line method, I'd like you to recall that we have to determine the amount to depreciate, and that is simply the purchase price minus the residual value. And also recall that this is an estimate. You know, we think we will get $20,000 for this at the end of its useful life. Facts may change in later years, and remember, well, you might not have seen this yet in your accounting education, but sometimes we will revise depreciation rates if we have a more accurate estimate of what's going to happen in the future. But for now, we're going to take that historical cost, we're going to subtract estimated residual, and this 120 here is the amount to depreciate. So, how many years of useful life? Well, I'm going to say 8. We plan to keep this 8 years. So, very simple calculation. We just take the $120,000 and we divide it by the estimated years of useful life. So this $15,000 here is your yearly depreciation. And if you bought this machine really close to the beginning of a year, then you would end up with depreciation expense of $15,000 for the year. So let's go ahead and just do a journal entry for that and make sure we can see what that looks like. So you got up early on New Year's Day and bought this machine. Yeah, I know who does that, right? So here's buying the equipment. So we're going to debit our equipment for the purchase price of $140,000. And of course, we don't know how we're paying for it, but let's say we paid cash. So here we can credit cash. Okay, so that's just buying the equipment. Now remember, we calculated a year of depreciation. So let's say year end is December 31. And our entry is depreciation expense, probably a comma and equipment, just so we know what it's for. And then we're going to credit accumulated depreciation. Okay. Now, I would like to remind you that like all adjusting entries, we have one expense account or revenue. In other words, a temporary account or an income statement account, however you want to think of that, that's our expense. And then we have a balance sheet account. And accumulated depreciation is in fact a balance sheet account. It is a contra account to equipment. So it reduces the book value or carrying value of equipment. So when we have $15,000 of depreciation our first year, if we were to look at a balance sheet on December 31, it would say something like this. It would be equipment, 140,000, less, less accumulated depreciation, 15,000. And then we would underline that. And we would say that is 125,000. So that's net. Okay, so we've looked at the basic idea. Now remember, the thing about accumulated depreciation, funny enough, it accumulates. It gets bigger every year, and that makes your carrying value of this equipment lower every year. So with straight line depreciation, we're going to do this $15,000 entry every year. And next year, after the second year of ownership, it's not going to be 15, it's going to be 30. And of course, your carrying value goes down. Okay, so that's just a reminder of your balance sheet for depreciable assets. Now, let's say instead that we purchase this partway through the year, because honestly, who gets up New Year's Day and goes and buys $140,000 of equipment for their company? Maybe nobody. So more likely we bought it, let's say, on August 20. Let's say we bought it August 20. So now we're talking about a partial year of depreciation. And this is quite easy. There are different companies in the world and of course different methods, and remember, depreciation is an estimate. So one company might say, hey, we're not going to take any depreciation the first year, but we're going to take a full year in the year we sell it. And some company might say, oh, we're just going to charge half a year depreciation in the year we buy it and half a year depreciation in the year we sell it. And it's an estimate. That's a reasonable thing to do. What we're going to do is we're going to round our depreciation to the nearest month, which is another common practice. So that means if you purchase anything from the 1st to the 15th of the month, you're going to round down. Okay, so if we had purchased this on August 7, we would round down to August 1, and then we would have 5 months of depreciation: August, September, October, November, and December, rounding down. If we buy this anywhere from the 16th to end of month, we're going to round up. Okay, so this was August 20, which means we're going to round up. For depreciation calculation, that means we're going to go to the end of August, meaning we're going to have 4 months of depreciation in the year of purchase. Okay, September, October, November, and December, just 4 months. Okay, so this is easy to figure out. All we're going to do is we're going to take our yearly depreciation amount. We're going to say, okay, I want 4 months out of 12. So we're going to go 15,000 times 4 divided by 12. And that gives us $5,000. Now, you could probably do that in your head, but it's not always that easy. Okay, now notice 4/12 is a third of a year. A mistake you would be making is if you say, oh, 4/12 is a third of a year, I'll use 0.33. Well, 0.33 is not a third. Notice that 4/12 is exactly a third, and a third of 15,000 is 5. If you round this off first, which I suggest you don't do, but if you did, you would say, oh, look, it's 0.33 of a year. And you would go, okay, 15,000 times 0.33 of a year, 49.50. Well, that's no good, is it? It's not 49.50, and it makes your life harder. So just recall, use this little formula. yearly depreciation times months divided by 12, and you'll always have the right answer over here. So that's $5,000. Okay, so if you had purchased this equipment on August 20, then of course your journal entry to purchase it would have been right here on August 20, and then your depreciation expense on December 31, as we just calculated, would be $5,000. Same thing in the year of sale. Now I'm trying not to do a super long video, so we're not going to get into sale of equipment and calculation of gain or loss. That would just turn this into way too long a video. So instead, let's just note that in the year you sell your equipment, you must bring your depreciation expense up to date to the date of sale. So if you sold it on June 7, then, well, let me make this easier. Let's say you sold it July 7. We would round that down to July 1, meaning you owned it from January 1 to the end of June, 6 months, and half of this for half a year, $7,500. Don't forget. So in the year of sale, first thing you do is bring your depreciation expense up to date. Otherwise, your other calculations are wrong. Okay. So that's a look at straight line depreciation. So now instead, well, actually in addition, I guess, let's look at declining balance. Now, first of all, there is a method called declining balance. It does not have to have the word double in front of it. And you have probably heard of double declining balance depreciation lots of times. Well, again, it's a declining balance method and you just doubled it. You could triple it if you wanted to, but your depreciation method should follow the usefulness of the item. But let's do this same purchase of equipment using declining balance depreciation. And then I'm going to go, once I find the declining balance rate, I'm going to do double declining. Okay, so same facts as before, except of course depreciation is not going to be 15,000. So I'm going to put this back. Here is the purchase of your equipment. Okay, so let's calculate this. Now the thing about declining balance depreciation is that we consider the residual value of this equipment at the end of the calculation, not the beginning. So even though this residual still is 20,000, we're going to ignore that for now. Okay, and here's the calculation. So 140 is what we start with, and what we're going to do is calculate the rate now. So 100%, there's 100 meaning 100%, and we're going to divide by the 8 years of useful life. And this is going to give us our declining balance rate, but we haven't doubled it. So we're just going to take the 100 divided by the 8 years, and I'm just going to increase the decimal here. You'll see that is 12.5%. So essentially 1/8. Okay. Now, double declining balance, we just take the straight line rate. Now, I shouldn't say straight line rate, but we take the 12.5, the basic declining balance rate, and we multiply it by 2. Okay. So we're going to have 2 times 12.5. I'm sure you know that's 25. So this is 25%, and we just calculated our rate. Easy, right? So the journal entry on December 31 is the same account titles, except instead, here's what we're going to have. We're going to have our $140,000, and the rate is going to be 25%. So we take 25% of that number. And we get 35,000. So 35,000 is our first year depreciation. Now what you should notice then, or maybe remember about this, is that it's called declining balance as a method. So if we consider our carrying amount is currently at the end of the first year, our original price minus the 35,000 depreciation, or 105. The next year, we simply take the 105 and we do the same thing. We're going to multiply that by 25% and get our new balance. So depreciation in year 2 is 26,250, and you can see, of course, it is declining, isn't it? Your balance or your carrying value is going down. Now, I'm going to just show you in a table here how this ends up. Okay, I'll just get rid of this so we have some room. So, let's do this. So here's your 1, 2, 3, 4, and 8. So I didn't count when I dragged this down. There's 8 years. Now here is where we have to consider the residual value. Your residual value was $20,000. That means the carrying amount of this equipment cannot go below $20,000. So you have to take this next one up, end of year 6, say, okay, 24,917 times 25% in year 7 is 6229. That's under 20. So that's not going to work. Instead, our depreciation is going to be lower. It's going to be our carrying value minus the 20,000 residual, and what that does is it gives you a lower depreciation expense in year 7, but it gives you the carrying value equal to your residual, and that means in year 8 there won't be any depreciation. Okay, so these are your depreciation figures for 7 years. Even though it was an 8-year life, the double declining balance is an accelerated depreciation method. Things depreciate pretty fast. And the thing to remember about this in particular is that we do not start by deducting the residual value. We simply make sure we don't go lower than residual as we depreciate this article or this equipment. Now, just before we wind up this video, I'm just going to show you partial year depreciation using double declining balance. And I'm just going to go from here. Now, notice that this, of course, is a full year. So once again, we're going to say that we purchased this equipment August 20. Well, we already went over this. We round up to the end of August, which means we have depreciation for September, October, November, and December. So 4 months in our first year of ownership. So all I need to do is adjust this figure. I've already got 140,000 times 25%, and I just did it, divided by 100 to get the right number here. All I need to do is adjust this formula by going times 4 divided by 12. And of course, it's a much smaller number. Here's my new carrying value. Now that was pretty easy. This is your first year depreciation. Now the odd accounting text is going to tell you to split this up and do part this year, part next year, and keep track of the two halves of the year. That's baloney. You don't have to do it. Mathematically, this works. So just simply take your $128,000 and now we can simply do a full year depreciation. So the full year then is going to be your 128 carrying value times 25%. And I put that in as a regular number, so I have to divide by 100 to turn it into 25%. There's the next number. And we have, whoops, not equal. We have the original carrying value minus the new depreciation, and there's your new carrying value. So when we run this down, this may or may not work. It did. Okay, so as we run this down, these are our depreciation amounts for every year. But because we started late in year one, in reality, if this was August 20, year one, if you add 8 years to that, you're going to get to August 20, year 9. However, we still run into the same issue. We run into the fact that over here at the end of year 7, we have a carrying value of $22,841. We can only go down to $20,000. And of course, if we take this, there's only $2,841 available of depreciation. So we're just going to change this to $2,841. And there's our residual. You'll notice because we bought this near the end of the first year, this adjustment occurred during year 8 instead of during year 7. Okay? But at this point, unless you have changed the residual value, done a whole change in estimate, which is part of the curriculum of intermediate accounting, intermediate financial accounting, unless you did that, this is still your residual and your machine is sitting there at the residual. Okay, so that's just a little review of depreciation. Hope that helps.